Welcome back, boys and girls. Follow up on yesterday's video. I wanted to talk a little bit more about some of the events that could cause this liquidity to really dry up very quickly and cause this credit stress event. And I want to talk about the AI circular economy. You've probably all seen this image posted all over the place where Nvidia has been investing in multiple AI players, and they're turning around and buying Nvidia chips, pumping up Nvidia's revenues. I think this is I think we've been starting to see more and more of this behavior because I do think that liquidity, available lending capacity for these AI startups is starting to slow down, and because of that, we have this. In order to keep the foot on the accelerator, these companies are now investing in each other and performing a very similar circular economy to what we saw in the dot-com bubble. But I do think that Nvidia's market cap, while Nvidia I've owned as a young person, I started building my own gaming computers. My first several gaming computers, I had Nvidia GPUs. Like back in the late 90s and early 2000s, I was all about Nvidia GPUs. And so, I mean, it's not like I hate Nvidia, the company. I just think they're wildly overvalued. And having been an Nvidia shareholder from way back in the early 2000s, along with an AMD shareholder, I've seen the market go from being completely underestimating the potential of these companies to massively overestimating the potential of these companies now. And I want to talk a little bit about what I'm seeing there. Now, when it comes to AI, I'm starting to see more and more comments like this where people are starting to sour. I've been saying LLMs are way overrated for a very long time. You can see here Wall Street Mav says that AI doesn't seem really intelligent to me. It seems like a huge database, everything loaded into it, program designed to chat to you. AI is not innovative or thinking up new thoughts. It's just regurgitating whatever it's loaded into it. And that's absolutely true. That's been true for a very, very long time. It's the sentiment that we're on the cusp of AGI, general intelligence. It's simply not true. The way LLMs work, they're very, very simple. They produce very impressive results, but they are ultimately very simple. I'm going to play, you can't hear the audio, I'm going to play you this little video that I'm going to walk you through what this video here is talking about. But it's talking about how LLMs work, right? So basically how an LLM works is it has a lot of pre-programmed information. It basically takes a large amount of data, a volume of written data, and it basically is able to calculate what the next best word is in any statement, and it strings together an estimate, a mathematical calculation of the most probable, you can see it here generating the next best word, the most probable next best word based on some context. But it's a purely mathematical calculation of what is the next best word to put, and it's literally just loading one token at a time, next best words. And so the sentiment that it's just aggregating a lot of other data is very, very true. So you take all of this aggregation of what's been written out there, but what this means for LLMs is that whatever the primary discourse is, whatever the most voluminous amount of information on a topic is, that's what's going to get rolled up in LLM answers. And so, there are many, many examples of things that have been talked about, written about largely, that have a lot more information written about them that are actually wrong, right? They've been proven to be wrong. But it's very, very difficult for LLMs and AI to differentiate that the large amount of information that's out there that's actually wrong is wrong, and it's much more difficult for it to figure out that the much smaller subset of information about a topic is actually the correct information. And so there's a lot of issues with the way that AI LLMs work today and the training data sets work today. And there's many, XAI is probably on the forefront of trying to weed through the noise and provide as much signal as possible. But nonetheless, with LLMs specifically that are trained on all of the available data on the internet, the big problem they're going to continue to have is weeding through the, again, if you look at, just an example, the mainstream media may parrot or repeat things that are actually factually inaccurate, and then they print a very small redaction later on, right? But the LLM is trained on all the articles that were written that were wrong, and it's not really trained to pick up the one-sentence statements that they were actually wrong about this and prioritize the inverse of what that article was saying. So just a little bit about how I think AI LLMs specifically are vastly overhyped. Now, that doesn't mean that AI doesn't have huge potential in the market. For example, full self-driving is finally, after me saying for years, I mean, I was having discussions with people back in 2018 that full self-driving was nowhere near, and everybody kept telling me, no, it's certainly coming by like 2020. And full self-driving is just now. Tesla, there was some videos of Tesla cars driving without any passengers at all around Austin, Texas, I believe just yesterday. So that's finally coming to fruition. But when it comes to specific applications like that, Tesla took a very curated set of training data. They took training data from their own cars, curated training data sets, and they fed that into the computer. So when you have curated, very well put together data, the output is a lot more predictable, right? So the output is a lot more accurate for full self-driving training data because they've been able to really meticulously curate that data. There's not a lot of driving is driving. There's not a lot of like false information about how humans behave when they're driving. But when it comes to training LLMs, it's much, much more difficult in the universe of information that's available on the internet to weed out the bad data from the good data. So that's one problem. Another problem is just the application of it, right? So because I believe LLMs are massively overhyped, people, especially people on Wall Street and people in finance, they may use LLMs and they may produce very impressive results. And so they think, as they look at this, being non-technical people, they think that LLMs are far more advanced than they really are because there's a lot of applications in finance. And so finance people have a propensity to maybe over-invest and overemphasize the value, the long-term value of LLMs specifically. And when I say LLMs, I mean large language models. What we're talking about is your typical ChatGPT, Anthropic Claude, XAI, Grok, right? So all these chats that you interact with that produce some very impressive results, but they are still, at the end of the day, these large language models that are trained on a universe of data that's hard to curate. So you see the results too here. I hear a lot of people saying, yeah, but these big players, Meta, Facebook, Microsoft, they make plenty of money. They're going to they can pay for all this stuff. Well, many of them are cash flow positive, and they're able to fund a large data center build-outs, but in the universe of everything that's going on in AI, they are not able to justify the capital expenditure that's going to go into building these AIs, even though Facebook and Microsoft are very profitable companies. That doesn't mean that all of they're going to want to continue to lose money on building AI out, and secondarily, that doesn't mean that they have the ability to continue to fully fund AI as time goes on. And you can see here, if you look at Meta, Amazon, and Oracle, the free cash flow has actually been reducing, right? So this capex is starting to catch up with them, and there's not a cash flow equivalent. AI is not generating enough cash flow to keep up with the expense. And we can see there's a lot of stress. Oracle right now is going through some difficulty because they don't have the, as Jim Chanos here, I was listening to his interview here. He's talking about the fact that Oracle doesn't have the same massive cash flow that these other players do, much less all these AI startups certainly don't have the cash flow these other massive players do. And now we've got negative cash flow for Oracle, which is projecting earnings forward, but they're currently at negative cash flow. And we see reducing cash flow as these big web titans are, spending more and more on building out data centers, AI training, AI inference. They are actually not getting the return. We can see it in their free cash flow, available cash flow. And so as that cash flow declines, there's several things that are going to happen. One, those companies are going to be hesitant to continue to spend and hurt their bottom line free cash flow. Secondly, when banks look to lend for these mega projects, if they're looking at declining cash flows from these players or negative cash flows and continuing to grow negative cash flows from the startups or even the oracles of the space, they're not going to be as willing to continue to lend to this AI economy. And this is why I think you're starting to see more of these circular AI economy games. I've been seeing it, frankly, I think it all started early this year. So we'll talk about when I think the shift really happened, and we're going to talk about some very technical information about Nvidia itself and how they make money as a business. But before we do, again, just want to highlight, I've never sold any sort of trading system or access to my Discord. I've never monetized my presence online. I've always done it just as a community favor, and I'll continue to do so. I make most my profit comes from being a profitable trader and a profitable investor. Otherwise, I'm just giving back to the community. But I do want to highlight I am diversifying into real estate. We do have vacation properties that we're starting to build up. My first property is in Crystal Beach, Texas. I will highlight in future videos additional properties I have. I actually want to do a follow-up video also that talks about the economies of the real estate markets that I'm getting into, because we're looking at just to give you some back of the napkin math on these sorts of properties I've been looking at. I'm looking at a total annual or internal rate of return of 25 to 30% a return on these sorts of investments. So I think real estate is a good place if you've got some you want to diversify out of crypto and stocks, take those profits. But you have to be very careful because there's a lot of very poor real estate investments and there's some decent ones. But I'll put the booking link for our beach house. I'm calling it the Bitcoin Beachhouse down in the link below. If you're in the area and you'd like to bring some friends and stay at our property, filling it up would help me out immensely. All right, back to when I think the shift actually started. So if you see here, way back in February, there was an article that came out that the GB200 wafers for the AI training variant of the chip were repurposed for a 5090 GPU. So a consumer grade 5090 gaming graphics card has the same basic wafer or similar wafer, so they can repurpose. So what happens, how Nvidia actually makes money as a company, is they're a chip designer. They don't actually build the chips even. They just design the chips. They design the chips and they find somebody else to make the chips, usually TSMC, but they have multiple chip partners. But they have large number of commit orders. Specifically, you see here excess yields from TSMC. They've got very large commit orders for entire wafers. And what a wafer is, I decided to go find a picture of a wafer for you while I was talking about it. So what a wafer is basically this is the substrate onto which the integrated circuit chips are printed. And so chip makers will buy entire wafers and then put their chips, they stuff as many chips on this wafer as they can from the manufacturers of these chips, TSMC being the big one. And then what they do is they cut out, you saw that big wafer right here, see those these are little individual chips in here, inside here, and if you go back here, you can see this is basically an individual chip cut out of a wafer and then put as a larger chip that you can put on a motherboard, right? So how these companies make their money is they buy wafer capacity from the TSMCs of the world, and TSMC builds the chip to their specifications, and then Nvidia turns around and sells the fabricated chip at a markup from what TSMC made it for. So for example, I think wafers are like $20,000 or $30,000 for an entire wafer, right? So like if you have a modern 3 nanometer process wafer, it's just to say it's $30,000 for that whole board, right? This whole board, $30,000, and you can carve out 100 or so chips out of that. So you have a certain cost per chip depending on how physically big the chip is. So the smaller the physical chip, the more chips you get, the less you have to sell those for. But the more die space that you use up, the larger the chip, the more wafer space you're using, the more you have to charge for the chip. But there's a spread between how much they actually pay for the chip to be made versus what they can sell it to in the market. Nvidia currently has a massive markup because they have the best design for these very highly parallel GPUs that are in demand for AI training and AI inference workloads right now. But you see here, like it was as early as back in February, there was already starting to be signs, and this is when the games, all those circular economy games, this stuff really started to ramp up early this year, around the same time I was seeing this news. And I highlighted this, I told somebody else this, I said, wait, when 5090s are available in mass, when you can just go on to Newegg or Amazon and buy a 5090 and it'll be delivered, like that same week or the next day even, that tells you that 5090s are now in capacity and they're not selling as many data center AI grade chips, and they're actually starting to make more consumer grade chips because they make a whole lot less money on the consumer grade chips. If you go here to Newegg, if I start 5090 GPU, a year ago they were all sold out. There was no 5090 GPUs available anywhere. And remember, these are the same. They have to take an entire wafer away from building AI, much higher value, much higher margin AI chips to build these consumer grade chips. But now there's just a ton of these 4090s in stock all over the place, and you can get it, you can order it and have it shipped and be at your house tomorrow, right? So this is a drastic, huge change from just a year ago. So I think the real demand started to dry up about a year ago, and then the financial games probably started about then. Specifically with Nvidia too, what I want to highlight is, again, Nvidia is just a chip designer. They don't actually physically make the chips, right? So their entire business is staying ahead of the competition. Nvidia, or specifically staying ahead of AMD and Intel in chip design, right? And I would say honestly, Nvidia is probably about 6 to 8 months ahead of AMD and about 12 months ahead of Intel with chip design right now. Is about where I see it at. So that means that they perpetually have to maintain that 6 to 9 month lead. But AMD is quickly closing the gap, and specifically, and Intel, there's a partnership between Nvidia and Intel right now where they're going to be working together. But Nvidia really only has the GPU market. So something I want to highlight here is, I've for years I've watched AMD. I still build, my own PCs, and I still follow the whole space. And AMD CPUs are superior in the market, I would say, and they have a distinct advantage when it comes to workload that requires both CPU and GPU and high performance memory or high performance communication between the two of them. But they also have advantages. They have more memory and a few other things. So they're actually better in many inference workloads. I think you see Grok highlighted in inference. They are actually superior to NVIDIA in many ways. So while the market is completely enamored with NVIDIA, as competition ramps up, there's going to be a compression of those margins that they make. Like the spread that they make between how much they pay for the wafer and then how much they can sell all the individual chips that are a result of that wafer is going to consolidate over time. And what you got to think through is, while they have a few month lead in chip design, that lead over time becomes less and less with each iteration of a new generation. People think of technology as exponential, but when it comes to advancements in silicon, it's really a very linear process, and it's actually slowing down. On the physics side, the physical die shrink side of those wafers, how small they can make the individual circuitry on those wafers, it is slowing down in how much we can shrink those. So the lead that they have in design, over time, each generation becomes less and less and less. So when this whole AI data center explosion, they had the CUDA cores, they were probably, when all this started, 2018, 2019 really is when a lot of this stuff really heated up. 2020, 2021, Nvidia had probably more like an 18-month lead on AMD in design because of how much more efficient, how better the CUDA cores were at the time versus what AMD had. And now, AMD's been putting a lot of resources, of course, into this, and they can copycat Nvidia, right? And they can just kind of copy a lot of the things Nvidia does shortly after they do it. And so there's just a compression, and Nvidia has a lot more resources, but you just can't avoid. Eventually, this space it's very, very difficult to maintain a lead in the space. And I've seen different industry players flip flop, and their lead, whether it be Broadcom or Avago or Intel or Nvidia or AMD. One will have a design lead for a period of time, and then they need a significant breakthrough in design to maintain that lead. And if they can't come up with a significant breakthrough, the other copycats will eventually catch up with them, and that's what will happen eventually. Now, I want to highlight here. I asked Grok to help me out here too on the slowdown in transistor die shrink. So, to this day, I currently make the majority of my revenue on trading and trading activity and managing my investment, but I still work in the technology field as well, and I work a lot with AI, but I work a lot with hardware and chip design. And so one of the things that I've seen is that ever since, and it's funny that I was thinking to myself for years now that around 7 nanometer, I noticed a specific slowdown in die shrink, the capability of TSMC to really shrink and optimize and make chips more efficient. You see here it says Denard's scaling started to slow down around 2005, 2007. I think it really slowed down right before COVID. I think 2016 to 18, I noticed it starting to slow down a little bit. Now, you'll hear the common narrative out there that I hear is that it's accelerating. It's going faster than ever. But that is simply not true. I know TSMC has been doing a good job of pushing. Now they're down to a 2, 1 point, and Intel's advertising 1.8 nanometer, this, that, and the other. But those are largely process efficiencies at this point. They're not actually making the die significantly smaller and more energy efficient. They're improving how they build those dies, the processes that they use, the materials that they use. All right, to illustrate this, what I'm talking about here, let's go take a look back at history. 1990. Okay, here we go. This is a whole lot better. So we look here in the year 2000, 2001, we were at TSMC specifically. I went to TSMC instead of trying to look at Nvidia GPUs. 180 nanometer down to 130 nanometer to 90 to 65 to 45 to 28. So from 2001 to 2011, 10 years, we'd gone from 180 to 28 nanometer. From 2020 to 2011 to 2020, roughly, we had gone from 45 to 5. And in the last 5 years, we've gone from 5 to 3, and then just now getting nanosheet 2 nanometers. But this is what I saw a specific slowdown, like I was saying, right before COVID. When we went to 7 nanometer, we hit some limitations at the physics that required a lot more work to get die strength from that point forward. So starting in 2019 at 7 nanometer, we started running into issues. This is the big one. This is the big hurdle. 3 nanometer is the big hurdle. Going from 3 to 2 to sub 2 is going to be a very, very long process. We've actually had 3 nanometer process available for many, many years. And I don't know if you guys realize, I watch this space all the time. While some of the Apple is buying up all the 3 nanometer capacity, and they've been using it for their for iPhone and Mac Pro chips for a couple of years now. They've been buying all this up. But Nvidia just now started making 3 nanometer chips, but there's no, as far as I know, still to this day, there are no 3 nanometer consumer grade GPUs or CPUs even on the market, and this process was available in 2023. Yeah, so you see here that process has been available, and it's been really hard to scale. Part of it maybe was COVID, but that process has technically been available for over 2 years now, and we're still not at AMD and Intel still do not have consumer grade CPUs on the market today. And then so I had Grok do Nvidia. So there are still no 3 nanometer Nvidia or AMD consumer grade GPUs on the market today. So the only consumer grade products on the market today are Apple. So what this shows you is, yes, there's a lot of marketing that these chips are continuing to shrink down in size, and the processors are getting better and yada yada yada. But the scaling it up has been an enormous challenge. And again, it largely was COVID slowing down supply chains and things. But the reality is, it's also physics. It's much more difficult to design at these sizes. We're talking atomic scale, right? And so you just have limitations rooted in physics beyond sub 2 nanometer is going to be exceedingly difficult. So my point is right around 3 nanometers is when we kind of hit a physics wall between 3 nanometer and the lowest possible size being just sub 1 nanometer. In theory, physics isn't going to let us go much below a single nanometer for a transistor gate. But at this stage, going from 3 to 1 is going to be, it's going to take much, much longer than going from 10 to 3, for example. Which is the same. It's really, going from 3 to 2 is a huge jump in efficiency. 3 to 2 is the same as going from 30 to 20 or 300 to 200, right? But what's happened is, again, as we get down to we're at the limit of physics. We're getting down to chip design, iterations in chip design and iterations in manufacturing and fab design. But it's also much, much harder to scale up and produce these chips at these sizes at scale. And it's extremely expensive. Extremely expensive. This is why there's no consumer grade chips in this space. The wafers at 3 nanometers are so expensive. The wafers at 7 are dirt cheap now. They've got that figured out. 5 and 4 are fairly inexpensive. 4 is still kind of expensive. 3 is exceedingly expensive. 2 is astronomically expensive, and the only people that can afford 2 right now are Apple, basically. But as this slows down, the point of all this is, as this slows down, the advantage that Nvidia has in designing the new iteration of chips is going to continue to shrink, and it's going to become more of a commodity. This is what happens with hardware over time. All of these hardware, there's a hype cycle going on with AI right now, but the reality is, when it comes to chip design and chips, these chips become commodity components over time. There was a time way back in the 80s when Intel CPUs were thousands of dollars, right? Their original 8086 and 8088, those machines cost thousands of dollars. The chip itself was $1,000 or $2,000 for a very kind of rudimentary chip, and that was pre-inflation adjusted. They'd be like $5,000 CPUs today, right? But over time, of course, the competition came in and it became a commodity. And now, you know, you can get a really good modern CPU for under $100. And inflation adjusted, that's like $20 back in the 80s, right? So all that said, Nvidia is at, I believe, here we go. We're at a little over four. It nearly made it to $5 trillion, $4.29 trillion market cap for a company that designs chips. It doesn't even make the chip. They simply design the chips and has somebody else make them, and they resell them at a markup. And the company that designs chips with a 6 month to 8 month advantage over the next competitor. The other thing that's going to happen over time that we haven't even discussed is the fact that as AI becomes more and more specific, so we talked about LLMs. LLMs are likely to hit a wall, and the problem they're going to have is filtering through the noise of all the volume of data out there to really give better and better quality results. This is a big reason why there's hallucinations, which is an entirely different problem. But there's a reason why a lot of times when you ask the AI something, it's flat wrong. It's because it's falling back on the most trusted and the most highest volume sources of information, which oftentimes are wrong until they later are redacted with a small redaction statement. But so what we haven't talked about is back to that Tesla model. Like we see Tesla's building their own chips for full self-driving their cars. They're building their own chips for Optimus robots. The actual chips that power the applications will be custom designed chips for that application. And that's really what's going to scale up in mass for real world applications like full self-driving, robotics. And once we hit the wall with LLMs specifically, we'll need another breakthrough. And eventually there will be another breakthrough that makes LLMs even more. There'll probably be reasoning breakthroughs, right? So the big problem with LLMs is the inability to do advanced reasoning. So there's likely the next breakthrough is likely a reasoning breakthrough. But what I want to highlight too is when it comes to LLMs, we've had AI chatbots for a long time. And they've been incrementally improving, but there's these step functions that happen where you have a significant improvement. And what gave the LLM such a big step function improvement was something called transformer logic. Okay, so this transformer logic allowed, basically, for lack of a better term, not being too technical, multiple layers of training, and it allowed the math that goes into the prediction side after the data is trained, the math that goes into the prediction and inference side to be far more precise and accurate, right? So these transformers allow that. It's also the inference of when you ask it a question, it's able to much better form the lookup matrix necessary to then populate a higher quality response. But this was a step function, right? So that when ChatGPT came out, was it version? I believe it was generative GPT. That's what ChatGPT stands for, generative transformer or generative pre-trained transformer. I believe this was actually 2018 when this came out. But this was a step function in chatbot or interactive AI, specifically LLMs, large language models, right? And so what I think people don't appreciate is that 2018 was a massive step function up in using these, and everybody's been using these transformers since then. And there's been small incremental updates to this, but the pace of innovation, the pace of advancement, really, maybe not innovation, but the pace of advancement in these is getting smaller and smaller with every generation. And in theory, because of the problem that we have of how you train this, the volume of data that's available on the internet, if there's a theoretical point where it actually starts to devolve and go downhill without adding more compute capacity, right? So the problem is there's a scaling wall that you hit. So you need basically as much compute capacity, and if we hit a physical limit of energy, say there's not enough energy to continue to scale up, in theory these LLMs could degrade model over model because there's more and more data out there, but there's not the equivalent amount of increase in compute capacity available to properly train those models with all that additional information that's out there, and they can actually start to degrade. This is a theoretical. I mean, we haven't hit that wall yet. I have no idea where that wall actually is, but that's a theoretical limit that we're going to have, constrained in just mostly in energy. How much energy can we put at these things? And chips. But I think long before we hit this limit, we're going to hit the real world financing limit, right? It's going to become apparent that this is slowing down. This is kind of a curve that's slowing down. And as the advancement slows down, the it's an exponential increase. Every one of these little steps up is an exponential increase in cost, right? So we go from spending 1 trillion to 10 trillion to 100 trillion to a quadrillion get past the scaling wall. It's like a quadrillion dollars in spending or something. I'm just making these numbers up, but you get the idea. So I think the reality of the financing constraints is what's going to hit first. So back to Nvidia. I'm just going to show you one more time the Cisco chart, right? Cisco still hasn't. They're very, very close. And what's going to be funny, Cisco still hasn't taken back the high that I marked on my chart from April 2000, right? When they hit their peak in 2000 of 80 something dollars, they still haven't quite reached that level again. I think they've closed daily. This is the highest daily close. So we've closed dailies above maybe their highest. I don't really know. Let's look at the chart closer. That's what I heard the other day. But nonetheless, we're just now getting back there. What's funny is because we're kind of in an AI bubble, Cisco had their first huge spike on the dot-com bubble, and they're having another pretty big spike on the AI bubble. It would be pretty funny to me if this actually hit and that was the top of the AI bubble, and Cisco also went down and had a double top. Of course, it's not going to come back down this much. It's a profitable company that's not in 2002 level, so it might pull back from here. But nonetheless, going back to Nvidia, I mean, just looking at everything I talked about, the fact that their margins are going to compress, their volume is probably going to slow down. There's going to be more competition. Um, they will make really good money, and they are worth more than they were when they were trading way back here. Back when we were trading it and buying it for our gaming for the the. Am I reading that right? Yeah, split adjusted. Oh my goodness! In 2002, when I graduated high school, it hit under 10 cents. Looks like it was just pennies. It was a penny stock after splits, and now it's gone from pennies. So it was just trading at under $1 in 2015. Just keep that in mind, right? It hit a peak of $1 in 2007 before the 2008 crisis, and then as late as 2015, it was trading under $1. 2016, it was still under $1, and now it's at $176. So it's still going to be a good company, and it doesn't mean it's going to crash, but the valuation is probably way, way, way over what it should be. And back to the liquidity thesis, when the funding dries up, banks quit lending for these AI buildouts is when you'll get a severe pullback. And I think the pullback we probably have topped in Nvidia. I don't want to say that for sure. The Q1, I wouldn't be surprised if we put in new highs and did a rolling kind of top in Q1. And it would not surprise me to get, this sort of price action. So rolling tops we're all familiar with, right? Into 2026. So I'm not going to say that this is necessarily the top, but it's likely closer to a top than a bottom. That's for sure. And as liquidity dries up, there's a lot of stress in the credit system. This is going to be one thing that when the credit dries up for this and the spend of AI starts to slow down, that's going to exasperate that credit bubble because there's been hundreds of billions of dollars that have been lent to different startups and companies for these AI buildouts. And the moment the banks realize that those are going to be bad loans, that they're not going to be able to recoup fully, and they're going to have some write-down losses associated with those loans, they're going to quit lending to other players in this space or be way more particular about who they lend to, at what rates they lend to. But that's going to continue to contract the available credit available in the system. There's a chance you see all these, you're going to see people talking about Head and Shoulders. There's a chance it's doing that. Wait for a break of the neckline. I don't know. I'm starting to build positions. If you go back to what I did with Bitcoin, right? This is, been a pretty strong uptrend. There's multiple ways you could draw this trend line. I don't know exactly if this is exactly how I would draw it. But what I'm looking at here is these moving averages. You see the 200-day moving average has been in a very long-term uptrend. And we're at a high risk point because price has put in kind of a very detached peak from when you get these big moves off the 200-day moving averages to a peak price, 43% off the 200-day moving average. When you start to pull back and lose momentum, and you start losing the 50 and the 100, and you still have the 200 below, a pretty safe bet is that this area here could see a pullback to at least the 200. So that would be your probably a pretty good, head and shoulders, maybe trading below the 200 moving average for a period of time. So it could break down from here into early next year and give us a lower high bounce to 180 and then roll over, similar to what we're kind of looking at with Bitcoin. I don't know, but at this point, shorts are on the table. That's all I know. And I did this whole video because I think it's now finally time. I wasn't comfortable shorting it even over here because of the liquidity picture. I was too busy with Bitcoin and everything else, but the gears hadn't reversed in my opinion. But ever since the tariff tantrum, this big move off the tariff tantrum, this feels like the blow off top moment in markets to me from the tariff tantrum into this move. It's this very, very, over V-shaped recovery over the top. Look at Nvidia is up 140% in 200 days this year alone, 140% up. And that's not normal. That's not normal in the market. So, I'm starting to build my position. The way I'm looking at it is I'm building my position. As long as we stay below the 50, I'll keep adding to my position on moves back up into resistance. And should we keep, rolling down, I'm likely to continue to build the position, looking for a much larger correction in the next year. But I'll let technicals lead the way here. If price does start to recover, I will not hesitate to exit. Yeah, I won't hesitate to exit or reduce position size. I would say at this point, if you look at this trend line here, as I'm kind of just mapping this out, I haven't marked up this chart before going to this video, but I'm going to just show you here. This level right here, 188. If we take out 188, this is where we kind of started forming this trend line. That's right around. That's an attempt to get back above the 50-day moving average that was rejected. If price retakes that level and takes that high back out, that means that we're now forming kind of a low, a high, a low, a high, a low. And if we don't take out this low here, I'll have to go look at it more closely after this video. But assuming we don't take out this low and instead we take out 188 first, I would probably get back on the sidelines and wait again for another attempt at a rollover. If we take out 164 first, I would personally, depending on the nature, if we follow this trend line all the way down and we don't break it, I would probably take a little bit of profit on my short positions at around the 200-day moving average, and then I would take more profit on a break of this trend line and look to reload short positions back up into this resistance level here. So those are all moves. I don't know if I'll make update videos on this or if it's just I just post these in Discord. Follow us on Discord. I haven't advertised the Discord, but my Discord is totally open, free to the public. Anybody can join. If you look at my X profile, I think I have in the video link, I'll have a link to the Discord in there. Feel free to follow me on X. What I try to do is I have my casual chatter in Discord, and I post a lot of stuff in Discord that I haven't really been, I don't have super high conviction on. I'm just kind of putting ideas out there and spitballing and brainstorming. And then once I think I have something of more substance, a lot of times I'll go post it on X, and it's kind of a more distilled. My posts on X are a little bit more distilled thoughts. Sometimes they're banter with people on X too, but most of the time my main posts on X are more distilled thoughts, and it's basically thoughts I've had, distilled from looking at charts, researching macro or fundamentals, and discussing it in Discord, then posting it on X. So if I don't do an update video on this in the meantime, just follow us on Discord, follow me on X. And just the general Bitcoin market, and do maybe a little bit more of a focused look at levels, ideas, how things. I talked a little bit about how things could play out before, but I just want to continue that discussion. That's probably the next video I'll do. I had somebody ask about metals too in one of the comments, so I don't have a strong opinion on metals yet. I haven't sold any of my metals. I'm just going to give you a brief summary on metals right here, right now. Basically, my thought process on metals is, this is a parabolic if we draw like on silver, which I have more silver than I have gold. But if you draw one of these, I don't know where it's at off the top of my head, so I'm just going to just draw it like this. All right, so we have a parabolic advance in silver. But I think, when you look at the debasement trade, I think Bitcoin is far more suspect to liquidity. But Gold sometimes acts as more of a hedge against uncertainty in the system, and silver has its own unique set of. It's really been it's been deflationary for years. As humans have been consuming more silver than we've been producing for years. So I think in the way that I do my investing, I'm not oversized. I'm appropriately sized. I think on metals, and I have bullion. I have physical metals mostly. So I've just been holding my metals. I may offload some of them whenever we get a break of this parabolic advance in silver, for example. Gold, I'll probably keep my gold. That's probably what I'll personally do. I'll probably not sell. I have less gold than I have silver. A good idea would probably be to offload some silver on a break of this, because next year if we do hit a credit event, the metals will sell off. I do think that sell off will be well, who knows how long they'll go sideways for, but they'll sell off and then they'll probably go sideways for a period of time and then they'll break back to the upside again. I do think that some rotation from silver on this move as silver catches back up to the silver gold ratio. It's been way lagging gold. Now it's starting to catch up. Once it catches up, selling some silver on a break of this parabolic advance would be probably a good idea to take those profits, sit on those profits in cash until you're able to buy the dip in gold. Gold will likely dip pretty heavily here. It'll come back to, I'm going to say, probably 2,500 or so on a massive dip in a credit correction event, maybe even 1,900. I don't have strong conviction on that either way, but you see these parabolic advances in the past, they didn't quite come back. I'm just looking at these. Yeah, we didn't quite come back to the prior test. So, give it 2,500, 2,800. I can see us coming back to 2,800. Maybe that's a fair spot. I'll do some more work on that. But, gold is likely to pull back and then to have a multi-year consolidation like it did, maybe not as long, maybe more like this one because of the fiscal dominance era that we're in. Probably more like a several year. This is what, the pullback started in 2012, 2013 to 2019, 2020. This is like about a 5-year window, 2013 to 2019, 6-year window. So yeah, I can see another 6-year window that we go sideways somewhere right around between 28 and 3,200, right? And there's your accumulation opportunity in gold. So take some of that silver you sold up here, accumulate gold there, and if the silver is probably going to be even more of a large pullback, so reaccumulate some silver at 30 or so. I'm just guessing here. Well, maybe we'll do a further video on metals. I got to do a lot more work on that myself. I haven't put much thought into it. All right, everybody, take care. Thanks for watching.